Our first speaker today is Mr. Jonathan Lavine. Jonathan is the co-managing partner of Bain Capital. He is also the chief investment officer of their credit business. He joined Bain in 1993, and he is actually the founder of the credit side of the business within Bain. Jonathan has a lot of interests, but he also has a lot of interest in supporting educational activities, and he's on the Board of Trustees of Columbia University. Columbia is actually a partner school of London Business School. We have a joint program together, and he's also involved in other non-profit activities around the world. Maybe before we get started, I'll say just a couple of words about Bain Capital. Bain Capital, I don't think it needs an introduction really. But at the moment, Bain is managing $160 billion worth of capital in a lot of strategies, close to 12 strategies, I counted, and 21 offices globally, 1,300 plus employees working for Bain Capital. And the portfolio companies of Bain Capital, I learned, employ 550,000 people. So a very significant operation that Jonathan is responsible for. And Jonathan will be speaking to us about a couple of very important issues, and maybe we can get started, Jonathan, on that. I wanted to ask about your perspective, just to get started, about your perspective on being publicly listed as an asset manager. Over the last year, I think I counted about 7 large asset managers in the alternative space listed or planning to be listed. So it's a trend, and I know that you know that a lot of your very large peers are already publicly listed. Bain is not listed yet. So wanted to understand a little bit your perspective on that. In an industry that has become successful by investing in private companies, but paradoxically is fascinated about being publicly listed. So what is your view on that, and if you see any potential conflicts or any maybe misalignment with your LPs if you were to be listed?
Sure. And first, I just want to thank you for having me. I think, particularly in a post-COVID world, these kinds of convenings are incredibly important. This is how people make contact, and Zoom has proven to be an amazing tool to add to our toolbox, but it is a tool. It is not an end, and I think it's great everyone is here today. As it relates to publicly listing asset managers, as with many things, there is no single right answer, other than you should do it for particular reasons. You should know why you're doing it. You should not do it because everybody else has done it. Generally, what we've seen in our peers that have gone public is they had an individual founder they needed to monetize. They did not have internal capital to execute expansion strategies that they thought were important, or they were trying to access some sort of balance sheet capital. Bain Capital has the good fortune of almost over our 40 years that we have devised the model to be a successful self-perpetuating partnership. We've been able to grow to 12 business units, 21 offices, $160 billion without any outside capital other than the partner's capital. And we very much have a culture that is right for us, which is that we invest alongside our investors. We are principal investors. And, if you think about what people would do with public stock, we take that value ourselves and put it into our funds alongside our investors. There's a never say never, but we have no plans to be public. We think that we can accomplish our business strategies the way we have. And we would always ask ourselves one question, which is our being private in some way a negative for our investors? Are there things we can't do in our funds as a private partnership that we could do as a public partnership? And so far, we think that just the opposite is true. That being truly private, being able to execute on our strategies, being able to have the single focus of our business model is a partnership among our partners and with our limited partners is the right strategy for us. And, obviously there's been very, very successful stories the other way, and that's how markets are made.
Yeah. And you think by staying private, you'd achieve a better alignment potentially with your investors, or is this something?
I won't do a comparative. I think that we achieve a unique alignment.
Yeah.
We are the largest investors in our funds.
Yeah.
And I think that it perpetuates a partnership culture where all we worry about is the investments in the funds. Mm-hmm. There's nobody at Bain Capital who is paid for AUM or EPS. We all are focused on returns and delivering for our partners. And as I said, that works for us. Mm-hmm. There's obviously other strategies and public strategies that have worked incredibly well, and it's probably good for the limited partner base that they have a wider array of heterogeneous choices of different types of firms with different styles and strategies.
Yeah. I mean, one of the main reasons that people quote for going public is that they can raise capital on their balance sheet and they can use that capital to seed new strategies. And you are already in 12 strategies and multiple geographies. What do you think is the next frontier in terms of investing? What is coming next? Is it maybe continuation funds? I don't know if the audience is familiar with continuation funds. Maybe you could quickly explain that as well. Or maybe accessing retail investors. Is that?
So first of all, a continuation fund is when companies in a private portfolio have hit a date where either the fund is maturing or the fund's winding down, or you would want to sell it, but you really think that it's got good long-term characteristics, but maybe not quite as much as the return as it was when it was a de novo, fully levered LBO. You create a new fund that your investors can participate in, and you continue to own those. So there's a lot to that question. So firstly, our particular strategy is look at what we're doing and see if we have fully developed it across our geographies, right? Private equity, credit, and public equity all started in the 80s and 90s in the U.S. Then we expanded across the globe, while we were also expanding into different types of private capital: venture, tech ops, social impact, real estate, a whole life sciences. Yeah. I could go through all 12, and on the capital market side as well. And then some of those are now looking at geographic expansions because of the partnership we have. We can work together and expand our footprint as appropriate there. And that may reveal itself in asset classes that are particularly interesting. We have a Japan middle market business that grew out of our Japan private equity business, which was more focused on large cap. So you look at the business that way and you ask yourself, where are we missing what we know how to do? And then are there obvious gaps? A few years ago, we saw regular way private equity style real estate as a gap we had. We have a very, very large special situations real estate business that was started by Alon Avner, who's sitting over there. But we recognized that filling in a U.S. more traditional private equity style real estate business. And different than some of our peers, what we did is we found an opportunity where a large university endowment, Harvard, was getting out of the direct investment business. We're both in Boston, and we were able to work with them quietly as partners and bring their whole team and all those assets over to Bain Capital, and that's how we started that business. Mm-hmm. In terms of continuation funds, I would say there's a bigger question. Undeniably, we would all like to have longer-term holds. That the business now has become vibrant enough and different than when the private equity business started or even the credit business. The companies are bigger, there's more market leaders, there's lots of long-term winners. And therefore, I think that can be accomplished through continuation funds, through permanent capital, through structuring funds that just in and of themselves have longer. You see some evergreen funds developing. And we, at various points in time, work with our limited partners to explore all of those things. But we also want to make sure the way we do it is because we think it is sustainable and not just because two other people did it. But I think over the next 5 years or so, you will see more broadly across our industry people, including ourselves, working on longer-term solutions to own really quality companies, not for 5 years or 6 years, but for 10 or 15 years.
Yeah. And how do you view private equity's access to the retail market? Is this something that you are considering, and what would be the pitfalls there?
So we do have some, retail is a lot of things. We do have some individual money. Our original fund was 100% high net worth families. Our credit funds and our public equity funds do have some, we either sub-advise or have some white label mutual funds, which we think are appropriate for those assets. We think that the democratization of finance and access to returns is always a positive thing. That providing people access to higher returning product is a good thing, as long as they know what they're getting, they understand the loss risk, and the lockup. And that retail investors are broadly not used to investing in things that they can't sell. But as we have at various points in time access those markets, if those criteria are met, we think it's a good thing. But there are reasons why there are disclosure rules, there are qualified investor qualifications, and I think it is partially up to the regulators, because they will have more data across everybody to really land on the appropriateness test, or people like us to come up with potentially closed-end tradable funds for high net worth. I think for retail, I do think, interestingly enough, high net worth ebbs and flows in the business, and they are that cohort of the market, particularly multifamily offices, very large family offices, are uniquely interested in this space now, and the interest has gone up as our industries have shown the ability to sustain returns through cycles. I think as we are doing more and more things that provide access, straight U.S. equity exposure, maybe something that high net worth families like, yes, I get better returns in a private equity fund, but I could buy equities. But access to Indian infrastructure plays, or an Australian airline, or Pizza Express here in London, those are things where we can bring to an individual investor global exposures that they couldn't get otherwise.
Yeah. I mean, you manage a very large firm, and you've been in the industry for many years. For our students, what is, in your mind, the definition of a successful firm? And by implication, what is the definition of a successful private equity individual?
So, a successful firm, first and foremost, needs to accomplish the stated mission of the firm, delivering outstanding results for its investors, because you have to, first and foremost, do what you say you're going to do. And then you have to be true to the values of your firm. We pride ourselves on the types of partnership we make internally and externally, so that the culture is there with CEOs, with communities, with each other. We recognize that what we do challenges conventional thinking, So we are not, we're the largest firm that's not public. We don't always follow the path that everybody else follows. So you really have to know that you have to know what you're good at, know how you invest, and stay true to it, and not fall prey to the newest thing. And as an individual, you have to have a certain level of intellectual curiosity. You have to be interested in the work. I always tell people, if you go to the investment industry just because it pays well, you're unlikely to be successful because very few people are really good at something they don't like doing. So you have to make sure you find where the intersection of your interest and your capabilities. You have to remember to play the long game. We live in a world now where my daughter was an analyst at one of the banks, and she was shocked that her second day as an analyst, people already started interviewing for their next jobs, like literally during training. And I don't, to state the obvious, I don't think that's good. I think that you should commit to an institution or to a job for some appropriate level of time. You have not mastered it after 10 months. And you should never, if you do make a change, run from something. You should always make sure you're going to something that you have consciously chosen to do. And then lastly, you yourself need to know, who you are, what you're willing to do, what your strengths and weaknesses are, but also the types of investments that you're proud to put your name on. And I mean proud in terms of, is it a company that I'd be proud to have all my friends and family know I'm involved with? You'd be proud that the work that is produced on it, whether or not it's a good or bad company, is work you'd be proud to say, this is my best thinking. And you'd be proud of the way you conducted yourself, respectfully towards the people with whom you partner, the management teams, the workers at the company, and that you can always go home and say, whether it worked or not, I did my best and I conducted myself in a way that I would be proud to talk about.
Yeah, very good. Thank you. Hopefully that will inspire some of our students here in
Yes.
the audience. We will open it up for questions from the audience, by the way, but before, maybe let me just throw one at you, Jonathan, and probably it's the most common question that you hear these days. How is inflation impacting, you think, the private equity industry and potentially Bain Capital?
So I think the first thing is very few of us have invested in inflationary markets in our lifetimes. It is something that people talk about in the 70s, and I vaguely remember the impacts on my father. I grew up in a sort of manufacturing community and what inflation did there. But in general, most people have invested through a non-inflationary market, which means that it is incumbent upon everybody, particularly the leaders of firms. At least I've invested through up markets and down markets. There's people who graduated business school in 2009 and until 2020, never saw a down market. And then that market was only down for like 90 days. And so there's all sorts of bad lessons that are out there vis-a-vis, but your experience can only be what your experience is. So firstly, you have to measure twice and cut once, because inflation is not a thing. It is the sum total of a lot of things. At any moment in time, there is always something that is inflationary, and something where you may see prices go down, deflationary. Computer chips for the longest time only went in one direction. Energy went up and down. What we are seeing now is everything's going the same direction. And because everything's going the same direction, including wages, we are in a scenario where I think that it is very hard to put your finger on when and how this turns. There's plenty of fingers being pointed on how we got here and why we got here, but how people flooded the markets with money in an absolutely never seen before global pandemic, I just find it really, really hard to be very critical of everybody doing what they doing what they could to try to save markets that could have, in economies that could have gone off the edge. So what do you do now? So one is you make sure that you study each component of inflation, because you have seen some things start to turn. Lumber turned in the United States, used cars are starting to turn, fertilizer is starting to turn, which will play into crops, which will play into food prices. So you have to have some framework of understanding that. Two, you want to make sure when you're looking at investments, remember, when you look at an investment, there's two things. There's the fundamentals on the basis of which you're investing. And then there's the price that you would pay for that. So you have to ask yourself, is inflation being accounted for in the price that I would pay for this earning stream and the new level of risk that I now see to this earning stream? I use credit spreads as an example. People always go bananas when credit spreads get wide. The whole world's going to end. You can't buy credit because it's at 700 over, can't do it. Well, credit spreads imply a default rate. The reason spreads get wide is because people think there are going to be wider defaults, more defaults because of inflation, because of the economy. Our job on the credit side is to say credit spreads are implying cumulatively over the next 4 years something like 20% cumulative defaults, 5-6% a year decline. Mm-hmm. Well, if I buy a portfolio of companies that I think only cumulatively has a realistic risk, we would hope to have our default rate is 1 or 2%, but in bad times, maybe cumulatively could have a 12% default rate. That sounds terrible, except that I paid assuming there was a 20% default rate, so we're better off. And it is the price-value equation that you have to think about. And you will see private equity firms buying not only at lower prices, and probably levering slightly more conservatively. Both the market will help with that and the firms themselves. But the business cases that we're all running, there's uncertainty out there. And when there's uncertainty, there's less price. For a while, people were paying high prices in a growing market with lots of good news. That generally worked for a lot of years because on the other side, the economic picture and the prices people were paying made sense.
Yeah.
The uncertainty that we see right now is obviously what happens in Ukraine. You may have noticed some political instability in the United States, and we have a midterm election coming up, and those things also all come into play.
Yeah. Do you think the price of fuel is one of the critical components of inflation?
I think that
will that continue? Or?
Yeah, I mean, fuel and food obviously are critical, and then wages, and the gap between inflation and the increase in wages, which I think right now is about 150 or 200 basis points, which is bad. But when people highlight 8% inflation, I think some people in their heads equate that to 0% on wages. So real wage growth is negative.
Yeah.
Wage growth has been negative for a long time in the United States in certain cohorts. And then there's all sorts of supply chain issues. And that is one that requires real analytical work and some time to figure out how much of that is going to work itself out. Everything from trucker shortages to pilot, go out to Heathrow and you obviously see that that is in and of itself a supply chain problem, what's going there with pilots and baggage handlers and all that. And a longer term trend, one of my colleagues pointed out yesterday that I thought was interesting, is this whole just-in-time economy that we've created that worked great right up until it didn't, because there was any interruption in that. If you see global onshoring, more domestic supply, more domestic supply chains, that will be inflationary, and that's inflation that will be a little bit more permanent.
Yeah.
And figuring out how that comes into play. Inflation and stagflation are the most complicated things you can talk about, but they're not impossible to study, and that's why we have 1,300 people.
Yeah.
And we know we will be wrong, which is why we are building in more margin of safety in everything we do.
Thank you very much, Jonathan. Thank you. We are running out of time.
You.
Much appreciated. Thank you.
Thank you for having me.
Thank you. Thanks for joining us today.